Kate, thank you very much indeed for coming in to see us this afternoon. If I can start by asking you about the impact of growth and indeed what's happening with these interest rate cuts. The Monetary Policy Committee at the moment has sat on its hands, and yet we're still seeing growth sliding a little bit. Do you think that they're on the right track at the moment?
Well, I would be certainly pretty surprised if we saw a change of policy in the short term. And the reason I think they're on the right track is, we have to face this. Monetary policy is pretty much as stimulatory as it can be. And it's an ongoing stimulus. People sometimes think because you stop cutting rates, it doesn't continue to have a stimulatory effect. But actually it does, because rates are as far below a neutral level as they can be. And QE should still be having an effect in the market. Sterling is very weak. All this is very stimulatory. The problem is, of course, that the forces that this stimulation is fighting against are really very, very strong. We've had the credit crunch, a lot of discussion today about the difficulties the banks still have in lending as much as they used to. We have the fiscal retrenchment, and then on top of that we've now had this big rise in commodity prices, which of course has squeezed people's real incomes and taken growth down further.
Indeed. And we haven't even seen the worst effects of the austerity cuts. I mean, we haven't seen the job losses in the public sector. There is more pain to come for people.
I think that's absolutely right, that there's more pain to come from what's going on in the public sector. Of course, one of the things with the consumer is, to some extent, there may be a little bit of anticipation of some of those difficulties. But certainly the issue for both fiscal and monetary policymakers is that the hope was that coming into this period of fiscal austerity, we'd have a relatively strong private sector economy. Now, it's not too bad. We've got to hold on to the fact that private sector jobs growth has actually been rather better than we might have expected. But household real incomes have really been squeezed. And consumption, we might all want it to be a smaller share of the economy. Certainly don't want it to disappear altogether.
Indeed. Now, we see still plenty of stimulus, as you said, in the market at the moment. And so really what more can be done? Because we're also looking at inflation on the other side of the scale. Should the MPC be worried about inflation at the moment, or really is the concern about growth more important?
It'd be pretty difficult to imagine an MPC member who isn't bothered by the fact that inflation has been persistently so far above target. But what would really worry them is if they saw either inflation expectations moving away in a sort of unexplained way that suggested that people had lost all faith in the target, and that really isn't happening, certainly not happening in financial market expectations, or if they saw wages growth picking up. I think you can take a bit too much comfort from the fact that wages growth hasn't picked up, however, because in some sense the big question for the MPC, it's also a question that lies behind the right balance of fiscal policy, is when you start to see some of these commodity price rises come out of the economy, we'll start to find out actually what's happened to supply capacity. And that will actually tell us both what the long-run pressure of demand on supply is, but also, much just as importantly, it will actually tell us how bad the fiscal situation is. At the moment, that is very hard to judge, because so much of what is going on underlying in the economy is concealed by the impact of these very high oil prices and the squeeze that's putting on us.
Indeed. Now, Moodys has come out today and said that the UK could lose its AAA credit rating because of growth. And that really is a bit of a slap for George Osborne, because he came in saying, look, if we don't do something about the deficit, rating agencies like Moodys could take away our AAA credit rating. He never mentioned growth. How seriously do you take something like that from a credit rating agency?
Well, because you have to take it seriously. But I have to say, in some sort of sense, I find this really quite hard to understand. When you announce a plan for your fiscal deficit reduction, you obviously have it's conditional in a sense on what you think is going to happen to growth, and it assumes a certain external environment. As I've just said, we've had a much worse external environment because of these oil and commodity price rises than we expected. It's not surprising to see growth slow down on the back of that, and it's not surprising to see it in the short term. It will make the cyclical fiscal numbers look a little bit worse. But what's the right answer to that? Tightening more doesn't seem to be the right answer. And so I was a bit surprised by Moodys, because I don't see, clearly the UK has to do something to tackle its fiscal deficit, but I don't see us as poised on such a knife edge that growth turning out to be a bit slower for a year, pushing the fiscal deficit up, is going to take us into some unsustainable situation.
Yeah, I wanted to ask you about, 1.5% growth. It wouldn't be the end of the world, would it? I mean, if everything else is on target and we're looking at 2% growth next year, that would be sustainable, wouldn't it, without having to implement a plan B, for example?
Well, it's not the end of the world. It's not going to be much. It's not going to be much fun for people, and it pushes out it has all these issues. We're very worried in some sense about what's happening to the supply side of the economy. If you let growth go on below trend, and 1.5 is almost certainly a bit below trend for a long time, you risk having people who are permanently out of work, you risk losses of capacity. So I don't think it's a good thing. Equally, I think you're right, it's not something to overreact to.
And when we saw George Osborne saying that there is no plan B, do you think he's right to stick to his guns at the moment?
Depends a bit what you mean by a plan B. I mean, I think he was quite right earlier this week to put a lot of stress on flexibility, to talk about the fact, of course, if growth's a bit weaker, fiscal deficit in the short term is a little bit higher. That doesn't mean that we have really deflected from their long-term aim of getting debt moving down towards the end of this Parliament. That seems to me to be the big issue that's around at the moment. While you're hanging on to that, a little bit of short-term noise isn't actually a plan B.
Kate Barker, thank you very much indeed for joining us.
Thank you.